Hey there, and welcome to our next live AMA. I'm Anna, as always, your host, and today we're talking about marketing due diligence for SaaS acquisitions. And I'm super pumped to have Shiv here, the CEO of How to SaaS, and Tim Heicks, our own brand CMO of saas.group. Welcome. Great to see you here.
Excited to be here.
Great. All right, then should we start with a bit of longer introductions? Who you are, just in a nutshell, what you do, what the company does. Shiv, will you do the honors?
Yeah, sure. I run a firm called How to SaaS. We work with leading private equity investors and their portfolio companies, as well as B2B technology CEOs, and we help them professionalize their marketing efforts and make it a data-driven, scientific marketing and demand generation engine. And we do this through three solutions. Number one is marketing due diligence, which is what we're talking about today. We also do strategy consulting, often after companies have been acquired or existing portcos. And then we also provide fractional CMO services. So we've been doing this for about 5 years. And we've also written a book on this topic. It's called Post-Acquisition Marketing. And it talks about what companies should be doing or PE firms should be doing after they acquire a business in the first 100 days.
All right. Hopefully, we'll be able to provide a link to the book. Tim?
Yeah, cool. Thanks for organizing the event, Anna. So my name is Tim. Doing marketing or with and for our portfolio companies at SaaS Group. So our team is supporting them exactly after the acquisition. So I hope I haven't read your book, Shiv, but I hope it's covering actually the work that we are doing with our portfolio companies. So obviously we see a lot what is working, what is not working. Therefore, we apply these best practices, these learnings across our portfolio. We have a couple of marketing disciplines in the team at SaaS Group, which our brands can work with closely, where they don't necessarily want to make the investment themselves, maybe in a SEO expert. So as SaaS Group requires, frankly, smaller companies. Not everyone has the possibility to afford a full-time SEO expert or a full-time affiliate expert, and therefore we come in with our team of experts and support these companies.
All right. Thank you, guys. So we've got quite a few questions lined up for this one. And I think the first question that I want to ask is, why do investors often overlook marketing as a part of the due diligence process? Chef, want to take this one?
Yeah, I think in general, when firms are underwriting investments, usually there are far more pressing matters. So that would be the first answer, is that they need to vet the founders, they need to look at the financials, they need to look at just sales and sales efforts, they look at pricing, they look at customer research and segment the market and look at building their own NPS scores for the target investment. So along the way, there's all this work that needs to be done, and they're also under a ton of pressure to close deals. And so they're trying to, once they've sent an LOI out and they're in a due diligence process, they're trying to get it to close. And I can tell you, being in these processes, there are hundreds of projects or tasks up in the air that looking at marketing due diligence often becomes an afterthought. That being said, I think the second reason is that it's new. If you look at companies historically, they have grown. Oftentimes, we come across even $100 million companies that have significant sales budgets, but very limited marketing budgets. And so, because of the fact that in the world that we live in now, marketing is important now, but 10 years ago, it was far less important in terms of how companies went about their go-to-market or how they tried to build pipeline. Investors are starting to now catch up to the idea that, hey, if I'm going to vet how predictable a target investment's revenue actually is, I need to look at their marketing quality, their marketing organization, look at their marketing budget to truly understand, are they efficient or not efficient? And then also look at what are the net new opportunities that this company should potentially be investing in. So I think we're very early days still. I think in about 3 years' time, even, this is going to be standard operating procedure for a lot of investors.
All right. Thank you.
So do you really see evidence for that? So I was asking myself, actually, PE companies, you had Thomas Bravo on your podcast, and it didn't sound like they are not looking into marketing during a DD. So I was wondering if that is really the case, or is it maybe just a certain type of investors is not necessarily looking into that?
Yeah, there are definitely investors that are more on the forefront or pioneers who get this from like an earlier stage than other investors. But if you look at the bulk of PE investors, I would say marketing due diligence is still not top of mind. That being said, like we have about 50 to 60 private equity partners that we do work with regularly, and we have been definitely seeing an uptick in the number of firms bringing us into deals as time has gone on. 5 years ago, when I started this company, we would get like one due diligence deal per year, and now we get several, and sometimes 10 to 20 per year. So it really depends. And I'd say the Thoma Bravos, the Vista Equity Partners, those types of firms in the world, they also have large ops teams. And so they don't just have deal teams that are buying companies. They also have operations teams who are getting plugged into the acquisition process and thus making far more requests during that process to understand the potential of a company. But most private equity firms do not have that many resources. They usually have one or two operating partners, or even if they have four or five, like they're spread thin across the entire portfolio. So they don't have deep subject matter experts on their internal teams. And so it just becomes a matter of prioritization. How much do we have to invest, and how fast do we really want to move?
Actually, what you just described is exactly how we are doing it. So we are working with our brands on their operational marketing stuff, but at the same time, we are getting looped in from our M&A team to really give our opinion and look into the nitty-gritty details, because sometimes there are really hidden gems to be discovered in that, and therefore I totally.
Yeah, for sure. And in those instances, it's like it's always a trade-off, because if you have, let's say, two or three operating people on operations people on your team, well, they can either go an inch deep and a mile wide, or a mile deep and an inch wide. And so it's a trade-off between, do we focus on one company or do we focus on the entire portfolio? And then as new deals come in, especially if there's a high volume of deals, how many can you actually diligence out on the marketing side when maybe it's not central to the investment thesis? I'd say that's another factor, which I forgot to mention, is just in every deal, the investor has a core investment thesis about how they're going to recover the initial investment that they're making in the business. And if you look at the investment thesis of a lot of PE firms, marketing for different targets, marketing is lower on the priority list. And for a good reason in some cases, and not for as many good reasons in other cases. For example, if you were targeting 600 of the largest CPG companies in the world, or the Fortune 1000, well, in those cases, you actually have to have a very targeted effort against those accounts, especially if your deal sizes are like close to $1 million, where sales is doing hand-to-hand combat and connecting with these individuals. And so marketing's role in those cases is more supportive. It needs to do sales enablement. It needs to be part of trade shows. Anytime there's any products or features released, there's product marketing involved. And then there's a heavy focus on cross-sell, upsell motions, where with email marketing and events and webinars and things like that, that you're supporting the sales motion. So in those instances, if I'm trying to vet the potential of a target investment, the marketing due diligence that really needs to happen is, what is everything that marketing needs to do here to support the sales motion so that they can be a more unified revenue organization? But on the flip side, if you have a company that relies heavily on inbound or paid digital, or digital marketing in general, like content marketing, SEO, social, etc., as its primary go-to-market, then marketing due diligence is significantly more important. In fact, it's more important than analyzing sales or pricing or some of these other things, because there's so much value sitting inside those channels and avenues for growth. So I'd say in those instances, not nearly enough is being done, where maybe, let's say there's out of 100 deals, maybe 10 are actually being diligenced properly on the marketing side.
Mm. And how big is your team when doing such a marketing DD? So do you bring in a sales expert, a SEO expert, or do you rather bring a generalist?
Yeah, we usually, so we have a team of 15 people, but usually with every engagement, we bring a C-level marketer, like a CMO, into an engagement, along with subject matter experts as well. The reason being that if I look at a particular company, like any channel or avenue for marketing is actually a good idea. So you could give me any company in your portfolio, or any PE firm's portfolio, and I could probably find SEO opportunities inside those companies. But that's actually not the important question. The important question is, what is the first, second, and third, or what is the order of priorities? And if you look at every business, SEO might not be top of the list, even though there's opportunity inside organic traffic and scaling organic traffic. So you definitely need C-level marketers who can make that distinction and prioritize across all the different areas that marketing can actually invest this limited budget into.
So the next question would be about metrics, right? Everyone loves metrics. So what are the most important marketing ones that investors or acquirers, in our case, look for to indicate a good opportunity? Shiv, want
Yeah, yeah. So I think you have to. There are different layers of metrics. So level one is just global metrics, and so looking at global company metrics. So this would be revenue growth rate, what's your annual contract value, what's your lifetime value, what's your net revenue retention, what are your CAC payback periods. I think understanding that helps you understand the overall business dynamics and what is the context for which you're trying to build a better marketing engine for. Then level two is really understanding marketing specific metrics, and this is where work that's beyond marketing also comes into hand. So knowing your ICP, how big your total addressable market is, all the different segments that you're going after. So you totally understand like how many targets are there in this universe that I actually have that we're able to go after. Then number two is then looking at all the different channels that we're investing marketing dollars into and understanding our overall performance. So overall, you might look at marketing contribution to pipeline, marketing generated pipeline, marketing influence pipeline, and also revenue within all three of those categories. But then within each channel, you're looking at your conversion rates, looking at channel efficiency, looking at what your payback periods are by channel and by campaign. And that starts to give you an idea of how efficient an engine or a marketing budget overall is. Oftentimes we find companies where their CAC payback periods are 2 or 3 years long on certain channels, and other channels are way more efficient. And so the deeper you go, the better of an understanding that you have of that. Staying at the global level, you kind of get a blended CAC and understanding of what how the business is doing overall. But that's also influenced by other things like just how sticky the product is, how mission critical it might be with existing customers, how much referral business the company is getting. There's all these other influences. So to truly understand how marketing is performing, you kind of have to drill down a few layers.
We often see even blended CACs being used within one channel. So specifically on Google Ads, you can really make wrong assumptions if you just look at the overall Google Ads CAC or LTV calculation. So I mean, now with PMax campaigns, there's definitely brand traffic within that. Partially brand campaigns are completely mixed into the calculation. I think that is something we basically see in every second DD we do, that these are technical mistakes being made before.
Yeah, for sure. And I think that's why it's important to try to triangulate the truth with all the different dashboards and metrics that are available. So starting with the global metrics helps, because if you can see that the blended CAC is in a healthy range, that means the set of activities that we're currently investing into is producing a good outcome for the business. If you see something off in those metrics, now we have to drill deeper and to figure out where are those inefficiencies coming from. And then if overall we're pretty healthy, but if certain channels are not doing as well as others, this is an opportunity to potentially reallocate, reinvest, or at the very least test out if turning off something changes your overall metrics or not. Like a lot of companies, if they see a lot of branded search and branded conversions coming through, it's possible that content is doing a great job of educating buyers earlier in the funnel, and then they do a branded search later, and that gets the credit. So I think it's just a matter of looking at all those metrics and trying to come to the right answer for a particular business.
Do companies you look at usually have that data available to be able to provide non-blended numbers, KPIs, or?
In most cases, no. I would say 80% plus of companies, maybe even 90% plus, do not have their data fully in order. The ones that do are dialed in, but the ones that don't, like, they might have some data in Salesforce, some data in HubSpot, some in particular platforms, and no one is actually taking all these insights and stitching them together to get a collective analysis built for the CEO or the board to make better decisions. And then when an investor comes in, obviously they need to ask these questions. And so that becomes an opportunity to push companies to actually build that discipline and professionalize the function. In a lot of cases, also, there aren't the right people inside the companies to actually get that data out in the first place. Maybe the marketing leader is not data driven. Maybe they don't have a marketing ops organization, or maybe they have a revenue ops organization, but they're entirely focused on the sales effort. And so you kind of have to redirect resources to actually get the right data out so that you can make better decisions. And then the other thing I would just say is that historically, if you've not set things up correctly, it's hard to get full historical data. And so in those cases, using more manual approaches and this concept, like I mentioned earlier, just triangulating the truth as much as you can with manual spreadsheets can go such a long way to making better, more informed decisions. You don't need a perfect attribution software to do that. And in fact, in a lot of instances, more software creates more problems versus trying to keep it simple and focusing on the base metrics.
Yeah.
We actually have the first questions that came from the audience. What primary questions do you answer for investors during the marketing due diligence process?
Yeah, usually it's we either get a very targeted question. We had an investor last year come to us and say, "Hey, we're thinking about buying a software company, but 80% of their business comes from Facebook ads, and I'm unsure if this is a predictable channel or if it's going to dry up or if they've hit their ceiling within this channel. And then also, are there other opportunities that this company is currently missing?" And so in that case, the entire due diligence process was really about vetting their spend on Facebook and figuring out how much more it could be scaled and whether or not they had hit a ceiling. In other cases, the question is more that, hey, we're buying this company that is it seems to be where they can spend a lot more on marketing, but they're currently not. So can you tell us about where all those other opportunities are in a prioritized way? And so in those instances, we're looking at all different channels and opportunities across the board and coming back with overall recommendations on where to focus. And then the third scenario would be that the company's spending a ton already on marketing. And as an example, we had one company that's spending over $10 million on paid advertising per year, and it's one of the leading software companies in its respective category. And we were asked if the spend is efficient enough. And as part of the investment thesis, they believed that there was a ton of inefficiency. And so they were like, is there an opportunity to cut the inefficient spend? And we came back and we found at least $3 million in spend that was not generating any revenue. And so depending on the situation, you can come back with a ton of different recommendations and value creation opportunities. In the case where we find $3 million of inefficiency in the paid media budget, that can now be reallocated to something that's far more profitable for the company, and it's going to generate more revenue and more EBITDA and everything else.
Yeah, budget allocation is definitely the most asked question. So how much growth can you achieve with the current given budget, or how much budget do you need to increase it to 50% growth year over year? I think that is often the starting point. And then with the ongoing DD, there are new questions popping up from product, from sales, and then obviously marketing also has a strong voice there to really answer those questions. So I think that is often underestimated, the interconnection between sales, product, and marketing. So you can't just see marketing as a separate siloed area. So you really need to get the insight from even from the tech DD, that like if you operate with a content management system that can hardly be managed by the marketers, obviously that limits our SEO opportunities quite heavily. So therefore, we are also dependent then on input from other areas, and then can steer again or define the next questions for the next iteration.
All right. Another question here is, do you see an opportunity to translate more marketing outputs as assets and business value terminology to increase business valuation?
100%. I think the more predictable your marketing engine is, the more valuable your business will be, right? So one of the number one reasons why deals fall apart, I think it's important to understand that investors have a ton of capital that they have raised from LPs that they need to deploy. The global dry powder, dry powder is the measure of how much capital investors have raised, but it's currently uninvested in the world right now is over $3 trillion. And so you think about how much capital is out there looking for an asset to be invested into, yet is not being deployed. That kind of gives you an idea of, is it that there aren't enough quality assets out there, or is it that there's just too much competition? It's a little bit of both, because when you find a quality asset, all of that capital rushes in to compete for it and it bids up the price. And on the flip side, if an asset is not as high of quality, then deploying that capital is quite risky, especially with the rates of interest currently, and how much you would have to put in to grow that business once you acquire it. So the investors are very motivated to buy companies. So why do deals fall apart? Well, when revenue is not predictable enough, then the investor is basically deploying capital in the hopes that eventually revenue will become predictable. And they might be willing to do that if they see other qualities in the business, but then they're going to pay a significantly lower valuation for that business. On the flip side, if your revenue is predictable, every month you can see that this is kind of what we expect. There's steady growth, or just at least steady predictability. We can factor in seasonality and understand how much profit and revenue we're going to generate in a particular month. That definitely changes how an investor perceives a business. So the role of the marketing team and the sales team actually is to make revenue more predictable, more scalable. And on the marketing side, because it's historically underinvested into, it's turning marketing into more of a revenue generator and turning it into more of a value creator for the business. So if you can make revenue more predictable and hit your sales projections and have enough pipeline coverage for the sales targets or the projections that you're making or promising investors, they're far more likely to invest and far more likely to give you the kind of valuation that your business deserves.
How much do you see platform dependency as a risk for predictability? So if
It
your
would,
business is based on, let's say, the Facebook ecosystem and or the Twitter, even better example, and then suddenly a new owner takes over and cuts some APIs and changes your whole business outlook.
Yeah, platform dependency, not as much, mainly because a lot of companies, for example, are heavily dependent on Google Ads or Instagram ads or Capterra and G2 and some of these platforms where a ton of volume for software demand comes from. I would say the bigger risk is actually things like customer concentration, where a handful of customers make up the bulk of your revenue, or you just have certain contracts tied to specific customers that without which your business would be growing at a much slower rate. So that's another, I'd say, to hedge that risk. And it's, again, coming back to revenue predictability, there's different ways to handle that. On the platform side, yes, diversify and be on more platforms and generate revenue, not just from Google, but also Instagram or Facebook or LinkedIn or Reddit or events and SEO and everything else that you can think of. But I think more importantly, the more you diversify, even still, if you're concentrated with a limited set of customers, that puts your business at risk in terms of it being acquired at all or a lower valuation. So the way to combat that, and where marketing and sales can actually really help, is building an engine that is capable of landing more revenue that reduces the reliance on a handful of customers. And we see that as a major problem where, because you're relying on a handful of MSPs or those handful of like major customers, your marketing and sales efforts are going into servicing those people more, or trying to find more customers that look like the large customer, which is a good strategy in one way. But if you only have a handful of those folks and you don't have a long tail of other customers, that kind of puts you in a tough spot. So I always suggest, like, diversify and have a strategy for every segment of your customer base, one for the larger accounts, one for your mid-tier accounts, and one for the lower ACV accounts.
Yeah, for the marketing side, I agree, but I actually meant more the product side, dependency on a certain platform. For example, you build your business, your product is offering additional features for Twitter, and or let's say WordPress plugin, which is only a WordPress plugin, and you just basically look at the data and you see 80% of your signups are coming from the plugin directory. Obviously, that's a cool channel for you because you don't necessarily pay if you rank high, but it has a high risk on
Sure. Yeah. I think it depends. I think it depends on the context and the tool. in some cases, it can penalize you quite a bit. But if you look at a company like Klaviyo, it's built entirely on the Shopify ecosystem. Significant valuation, worth basically $1 billion or close to thereof, and businesses like that have built significant customer bases because they were built on top of platforms with existing ecosystems of customers. I think there's a huge opportunity for, in general, for in software to piggyback against with a major vendor like that, because you kind of get this co-marketing boost. You become part of their partner ecosystem or their app marketplace, and there's inbuilt demand inside those places. So even though MailChimp exists or Constant Contact exists, Klaviyo was able to build a business because it was integrated with Shopify. And then the second thing I'd say is there is another different type of opportunity for smaller tools where, yeah, you're platform dependent, but it can be a profitable software or a solution that generates revenue. Doesn't need to be a unicorn in all cases, but it can be founder led, it can be bootstrapped, and be producing 20 to 30% EBITDA margins every year, and growing because it provides value to that platform. So I think depends. There are also obviously companies that are almost over reliant and don't have good revenue vitals to go with that. But I think the two examples that I mentioned, you can have pretty good business models built in those instances.
Yeah, that's interesting that you also see it like that. So we acquired a company called MyWorks, which was built on QuickBooks and WooCommerce, building basically the layer in between. There we were able to also expand to other platforms now. So that's a really great success.
Yeah, and it can be a beachhead, right? Like you can start with one platform and find your initial customer base there, and it laser focuses your feature set for that customer base. And then as you build enough revenue and pipeline and everything, you can take that same feature set and apply it to another platform. So you use the QuickBooks example, you could easily build the same app or create an integration with Xero, and now you have access to an entirely new set of customers.
Yeah.
All right, thank you guys. So I guess we kind of are like playing with the topic already a little bit, but I want to ask the specific question about that, and also because we've already decided that sometimes marketing due diligence can be overlooked by both sides. So is there anything that could be found during the marketing due diligence that could actually, be a potential deal breaker or really affect the valuation like in a bad way?
Yeah, I think we covered off a bunch of these in earlier questions, but just to reiterate, I'd say the revenue predictability piece, reliance on a handful of customers, and then hitting a ceiling in particular channels where you may be over reliant on it, or you're not sure if that trend will actually continue going forward. We've seen companies where maybe they get a ton of volume from certain influencers, but it's really hard to predict if that volume will continue. And so it's hard to give a good valuation in situations like that. Another one that I'll say is over reliance on the founder or one or two people to generate sales. So if the founder is the main rainmaker, we need some proof that the business can have some continuity. If the founder was to leave the business, or there's just basic key man risk. If the founder gets hit by a bus, does the business continue to operate, or does it lose most of its inherent value? So I'd say that one is like a really big one, and it's revenue concentration. Instead of a customer, it's on a key employee on the team that is responsible for most of the revenue.
I wouldn't necessarily call them deal breakers. Obviously, it has an impact on the multiples, but I also see and agree that the dependency on the founder's brand is a big one. But often there are some kind of hidden champions below the founder who can actually quite easily take over. So that is something we often see specifically at small bootstrap companies. What I would rather see as a deal breaker is hiding relevant information, which is then being discovered during the DD. So that is really a trust issue then, and that could really easily lead to a deal break. But
Yeah, that's why it's almost like it's critical to just be as upfront as possible with all the information And before even starting a process, it's almost better if founders fully gather a data room together, and then engage potential targets, because they're going to be even more requests and questions once that process starts. But if you don't have the basics identified and in a data room that you can then just say this is our starting point, then it's much harder to get a deal closed or even get going in the first place.
Yeah. And then some shady practices, for example, in SEO, that could also be very quickly lead to such a situation that you end basically the discussions. Let's think about, for example, some backlink building with some dubious networks, or what else? Or actually, your blog is being generated with thousands of poorly written AI content. So there, maybe you were successful to get your pages ranking high in the last 12 months, but there's also a high risk assigned to that your rankings will plump, and then obviously revenue is right away affected.
Absolutely, yeah. We all know that sometimes acquisition processes, they are, well, not really hidden away, but not a lot of people in the company are being introduced to what's happening. And it would be sometimes great to have a dedicated person to actually walk the acquirers through everything that's going on with the marketing in company. So how to prepare, the marketing team, or whoever is in charge of that in the company for this process?
I'm a big believer in transparency. So I know not everybody takes that approach, but personally, I believe that people should be looped in earlier in the process. And the more details you share and you explain the reasons why, the more people will be able to support the cause and willing to be a part of that as well. I think most people are, at least especially at senior levels, are more than mature enough to handle the complexity of a diligence process or an acquisition conversation. Now, that being said, if there is a culture inside of a business where that doesn't exist, then I think it's better to have at least a point person, ideally the CMO or the marketing leader, that is organizing all of this information, working with the CEO to get all the data together for the data room. But I think the more you loop in folks, the better, so that you can get as much information as possible into the hands of investors.
And you should also see it as an opportunity. So your market leader might learn from the process, even if the deal does not happen in the end. But just by answering or thinking about the questions that you get asked from from investors, helps you to build a better marketing tech stack, for example. So I would, as a founder, I would really identify one person in marketing that is capable of, uh, participate in the process.
All right. So while we are on people, there is an additional question that we just got. What roles or skill sets on an SMB B2B marketing team are critical to ensure effective data-led decision making?
Yeah, at the very least, you need, I'd say, as a bare bones essential marketing organization, obviously you have the marketing leader, you need a demand gen person, you need a content person, and then you need a data ops person. I think that unit of four can do a ton of damage inside most companies. And usually the missing roles inside those teams are the marketing ops person and the demand gen person. Usually there's some sort of a content writer or product marketer that exists, and then whoever's leading the marketing effort is also kind of playing the role of the demand gen person and the marketing ops person, which is fine, especially in the early days. But the larger you get, the more of those roles that you need. We've seen obviously much larger organizations where if it's $100 million company or $500 million company, the marketing team could be 150 people, and you have multiple people inside each of those functions that I described. But definitely the data person is critical, because everything that you're spending your money into, you should have the right dashboards and insights coming back to tell you what's working, what's not working, so that you can make adjustments, you can communicate back to the board or the CEO. And I think that's one of the most underrated aspects of all of this, is that the role of the marketing leader, that's understated, is to communicate upwards. Everybody understands that you have to communicate down to people that report into you, But the bigger responsibility is actually to communicate upwards to the CEO and the board to inform them this budget that you gave me, whatever it is, 500,000 or 10 million, or anywhere in between. What is the return that I have generated for you on that spend, and how do I know that beyond just subjective opinions and insights? And the better the marketing leader does that job, the more likely it is that you're going to unlock more budget and more support for marketing efforts, and ultimately get a bigger seat at the table.
But specifically for small companies, it might be hard to find the right marketing operations person, right? So I think there the wish is probably to find a better way to identify those people. Like, what else do they do if they are not marketing operations right now? Who are the people who can grow into such a role and develop the technical skill set for that? So I think that is something often we get asked. I personally feel like performance marketers can easier grow into that role if they are playing with Google scripts and all that stuff. That already shows a certain degree of technical expertise, or at least motivation to look into such stuff. And then the data stuff can be learned. I think obviously not the super sophisticated stuff, but these are kind of the candidates you would like to identify. So you wouldn't look for. I think it's easier for performance marketer than for a brand marketer look to grow into that.
For sure, yeah. And in the early stages, you can definitely repurpose roles or rely on subject matter experts or technical experts inside. You don't necessarily need a de facto marketing ops expert, but having a really good data analyst or a programmer from the developer side that is capable of getting you the kind of dashboards and reports that you want and can support the technical setup can just go such a long way. But as you grow your marketing organization, and when you graduate from 1 million to 5 million to 10 million to 100 million, you definitely need a more sophisticated function inside the marketing team that's dedicated to getting all that data organized and the insights pushed back to the team so that they can make better decisions.
Yeah.
Okay, so I guess we covered, what can be a deal breaker or what can negatively affect your valuation. But what could be these changes that founders or marketing teams can make to marketing to increase the chances of the acquisition deal closing?
Yeah, I think on the marketing side, it's making sure that you have all the fundamental layers in place and marketing is actually contributing more to pipeline. What we see is that marketing organizations in general that are immature aren't contributing all that much to pipeline. So a good way to think about it is just like benchmarks or baselines. If you're contributing less than 10% as a marketing organization, it's pretty much a non-existent marketing team. Even if you're less than 20%, I would say it's fairly immature as a marketing team. If you're above 20%, you start to get into more mature territory. And if you're above 50%, I would say it's quite a sophisticated marketing organization. And so first is understanding where are you on that spectrum. And if you are on the more immature side, well, how do you build maturity? It's by building all the foundational elements and then turning marketing into more of a revenue generator versus a support function. So as a support function, maybe you're doing events, sales enablement, you're doing some product marketing work, but a sophisticated marketing organization is actually driving revenue. So in order to drive revenue, you need to make sure that you have tight TAM and segmentation work done. Your product marketing, your messaging, your positioning is clear, and you know exactly who you're going after. Your website is at a sophisticated level so that when visitors come to your site, they're converting at high rates. You have great sales enablement and sales training for your sales team and creating the content that they need to convert prospects once they're at an opportunity stage. And then once those foundational elements are built, you need to have the right strategy. Like, are we going to market one-to-one or one-to-many and inbound? Making a decision there. Are we focusing more on paid media or SEO? Are we focusing more on account-based marketing or customer marketing? And as you get clearer on that, having roadmaps for all the different areas of where marketing can make an impact, and then ultimately starting to execute on that with the right resources and the right team and having the right organization in place. So the more you work your way through this process that I just described very quickly, the more sophisticated your marketing organization will be. And the more likely you will be of having an acquisition close, because you're going to showcase to investors that you can predictably bring in more revenue going forward, and it's going to be at the levels that they're looking at the business currently.
When you talk about 10 or 20% revenue brought in by the marketing team, you mean then clearly attributed revenue to marketing activities?
Yeah, in one way or another, and we can use different terms, but at the very least, marketing contribution to pipeline, 10 to 20%, shows certain level of maturity versus 50%, right? So in some companies, they don't even necessarily know contribution or generated pipeline. They know influence pipeline. Like that's not good enough. So we need to have clear understanding of how much revenue is actually marketing driven.
So, well, how much of your total revenue should be coming from marketing?
It depends on the type of business. So if you're a product led company, should be close to 100% or 90% because people are going to find you inbound. Your price points are so low, you can't really afford a sales team. So makes total sense for marketing to be the primary revenue driver. And in those cases, it's kind of hard to say if it's mature or not because so much pipeline is coming from marketing. And that's where you kind of have to look at other metrics like looking at efficiency and conversion rates and LTV and figuring out like the people that we're bringing in, is it actually sticky enough that they're staying with us for a longer period of time. On the other side of the spectrum, if you are doing more of an enterprise B2B sale, being at 25 to 30% marketing contribution to pipeline and revenue is actually a pretty healthy zone because sales needs to do the bulk of the work to build relationships and sell into those accounts. But if in an instance like that, marketing contribution to pipeline is less than 10%, which we see all the time inside enterprise B2B companies, that shows that there's significant opportunity for marketing to make a bigger dent and impact revenue.
Yeah, I agree. Like it totally depends on the business. You can, if you found your channel and it's scalable and you haven't reached the ceiling, then basically you can really scale it up to 1%. I think, but yeah, I think there's no golden answer to that question.
All right. Okay. Well, obviously, acquirers or investors are looking at what you're spending your marketing budget on, right? So, why is it being assessed so closely, and what are they looking at? What are they trying to find there
On the revenue predictability side?
on the marketing budget? Like where you're spending your money?
Yeah. What the marketing budget in and of itself is not enough information, I guess. So let's use an example. Let's say a company is doing 10 million in revenue, but their marketing budget is 300,000, and I'm using that specific example because I've seen that particular example at least 100 times. In that instance, I can tell you very quickly that that's not nearly enough marketing budget because they're spending 3% of their revenue on marketing. So I think number one is just benchmarks. Like where should a company at its particular size be spending marketing dollars in order to grow at the level that they'd like to grow to? Especially, let's say that $10 million company wants to grow by 30% this year. So they want to get to $13 million in AR by the end of next year. Well, in order to do that, they need to generate a certain number of bookings. And in order to generate those bookings, they need certain opportunities, certain MQLs, and a certain number of leads at the top of the funnel. If you don't know your conversion rates and you're not working your way backwards, it's very hard to know if you're going to hit that number or not. And then even if you do figure it out, let's say you get to a certain number of leads you need to hit that target. Let's say the number of leads that you need is 1,000 leads. Well, how much marketing budget is required, marketing and sales budget is required to generate 1,000 leads? And if you look at your sales productivity or efficiency, you might find that every year your sales team brings in 650 leads. So now you have this shortfall of 350 leads that marketing actually needs to generate by itself. And if currently marketing is only generating 125 leads, you now have another 225 leads that you need to generate from the marketing side, but you don't have the budget for it. And with your existing budget, you're only able to generate 125. So theoretically, in that case, that company shouldn't be spending 3 times the budget because 125 to 350 is about 3x, let's say. And so they should be spending at least 900,000 or $1 million to get to their growth aspirations. And if they don't, they won't get to 13 million. They'll get to 12.25. If the investors are okay with that, then that's fine. But on the flip side, like when they miss those targets, now if they kind of like what we see inside companies is VP of sales tenure is at an all-time low. VP of marketing tenure is at an all-time low. So what ends up happening is they miss the targets. They fire their VP of sales or their chief revenue officer. They replace their director of marketing. But really the issue is more foundational. If you don't have enough budget to generate the leads that you need, you're going to miss your targets. And so understanding that is why you need to look at the budget.
All right, we got an additional question, and I guess it can go like both ways. So, what software do you recommend to allow for data capture and tracking and analytics? And I guess I'll just add to it, like, what is your tech stack when you are doing marketing due diligence?
Well, we're in Canada. In terms of your question on tools, we're tools agnostic. Like one of the reasons we've contemplated building our software so many times, our own software many times, and the reason we don't is it's just better to be agnostic and not have a specific horse that you're pushing. We've seen companies be successful on Pardot and HubSpot and Salesforce and Marketo and Pipedrive and everything else in between. I would say don't be married to a particular tech stack. Make it work within whatever tech stack you have. Every tech stack has its imperfections. What you don't want to do is get in an infrastructure project where you're changing from one tech stack to another tech stack, because you can burn a ton of internal political capital making that shift. So just going from, let's say, Pardot to HubSpot can take 3 to 6 months to get right, sometimes even a year. And if you're a marketing leader and you're investing a big chunk of your mind share and time and effort and even your team's time into that, you can end up a year out not having generated more pipeline and revenue, but having a whole new set of data tracking problems that now you have to troubleshoot. And very quickly you can be fired because you're not actually delivering on expectations. So I'd say that mental shift is important, where it's not the tool that's the difference. It's the creativity and the planning and the strategy that really moves the needle inside companies.
So I'm a big fan of raw data, and then you can plug in basically every visualization tool on top of it. How to get the raw data, that is usually the tricky part. I think HubSpot is an awesome place to collect the CRM data. The cookie from HubSpot is great, which adds relevant source information to your leads. So that is raw data that you can use. But if you're a product-led growth company, you also obviously generate a lot of data in your onboarding flow. So how do you bring that data together? Either you can send it to HubSpot as well, or you put everything in your data warehouse together, and then you can really do magic with the numbers and come up with thousands of drill downs, exactly what you need by campaigns, by channels. Obviously, this requires some technical work and also experience. There are a couple of companies who are solving that. I think in e-commerce there's Triple Whale, but now there's also for SaaS companies a company called RefGems, actually a company founded by by a few founders who already sold their previous business to saas.group. So RefGems is plugging in the Stripe account and also adding additional data with a cookie, and then you can also do already really helpful data analysis that you need to make all these judgments. So that is definitely I would look into. And then I think your other question, like what kind of tech stack we are using during the DD. Basically the obvious ones. We use a lot of Google tools. We need access to obviously Google Ads, Search Console, and so on. If possible, we also look into the different data tools like Tableau, Data Looker Studio. I also often use tools like Wapalizer, BuildWith, or public www, like code search engines to find customers who this SaaS company is already working with. So sometimes there you get some interesting insights that you don't necessarily get from the pitch deck. Google Trends, all the Ahrefs and seeability to check the websites and the status of the SEO. So yeah, I think there are a lot of publicly available information that you can also use without even needing access to the company's tools.
Okay, thank you. All right, since we're almost at the end of our hour, I'll just throw one more question. Maybe you can share your biggest learning or the most unexpected learning from one of the previous DDs. Shiv?
Unexpected. I think just a broader lesson just from doing this for the last 5 years is just how little investors think about the marketing side. when I think they should be thinking about it a lot more, especially in the world that we live in. Like I was saying earlier, in general, when a transaction happens, investors spend more than $1 million, sometimes close to 2 million, on transaction related activities. This could be your financial due diligence, your legal due diligence, your technical due diligence, and everything else in between. And I think marketing is just very overlooked, especially when you're trying to figure out what the potential to grow a particular asset really is. So just that really stands out to me. And as we educate, we see our role. That's one of the reasons why we put out so much content and I work on the book and everything else, is because there's a market education component to what we do that needs to be done, because the market completely doesn't understand how important things like this are or will be going forward. So I think that's something that needs to change, and I think it will continue to over the next few years.
All right, Tim.
I think for me the biggest learning is how to identify the ceilings of certain channels. So Shiv mentioned that it's really important to understand if a company is setting a certain ceiling in it with the channel. But for example, partnerships. Often companies start, when they start doing partnerships or collaborations, they start with the most obvious ones, with the low-hanging fruits. And this sometimes gives them a massive boost, but this is not actually scalable going forward. So I'm quite suspicious when I see someone who has significantly grown via partnerships in the past, because that is really also partially then only based on the founder's personal network, but not at the first glance. So that is something I have learned for sure.
All right, that's a revelation. Well, thanks for sharing this. I mean, we've had quite a few questions from the audience, so thanks for the participation and thanks for all the insights that you've shared today. Thank you so much, Shiv, Tim. It's been great talking with you today, and happy to do it again sometime.
Excellent. Thanks for having me on. Appreciate it.
Thanks, Shiv.
Anytime. Thank you,
Bye.
and take care.